All right, let's dive into the currency markets today. We're looking at this new analysis from Morgan Stanley. It really caught my eye. Came across it in Pound Sterling Live. And it's all about the future of the U.S. dollar.
Hmm.
How it stacks up against the big players like the euro, the pound, the yen.
Yeah, it's an interesting one. Morgan Stanley's kind of going against the grain here. They're actually recommending selling the dollar.
Yeah, that's what really surprised me. I mean, usually a strong dollar, that's a good thing, right?
Right. Conventional wisdom says, yeah, strong dollar, strong economy.
So why is that? Help us understand that a little bit. Why is a strong dollar typically seen as beneficial?
Well, think about it. Strong dollar means imports are cheaper for us.
Okay, makes sense.
Helps keep inflation down. Plus, it makes U.S. assets more attractive to foreign investors.
So they want to put their money here.
Exactly. And that can boost investment and economic growth.
But Morgan Stanley seems to think this good run for the dollar, it might be coming to an end. Their analysis suggests we could see the dollar weaken against some of these other major currencies.
Yeah, and they're basing this on the idea that U.S. bond yields, they've probably peaked, and they're expecting them to start declining soon.
And that's a big deal because rising bond yields, those have been a major driver of the dollar's strength, haven't they?
Absolutely. Especially think back to after Trump's reelection, all that talk about inflation, that really pushed yields up.
Right, right.
And those higher yields, well, they attract foreign investors. They need dollars to buy those U.S. bonds. So that demand pushes the dollar's value up.
It's like a self-fulfilling prophecy. Expectations of inflation lead to higher yields, brings in the foreign investment, and that just makes the dollar stronger.
Exactly. A bit of a cycle there. But Morgan Stanley's kind of thrown a wrench into that whole cycle.
So what are they saying?
They're essentially saying, hold on a sec, maybe this inflation thing, it's not going to be as bad as everyone thought.
And they're basing that on...
Well, there's been some recent data that suggests inflation might actually be cooling down.
Wow, okay.
So they're arguing that this disinflation process, basically the slowing down of the rate of those price increases, that's back on track. And that kind of weakens the argument for yields to keep going up.
So if inflation's under control, there's less pressure on the Fed to keep raising interest rates, which would normally push those yields higher.
Precisely. And remember we were talking about term premium earlier, that extra return investors want for holding those long-term bonds.
Right, because they're locking their money up for a longer period, so they want to be compensated in case inflation eats away at its value.
Right. Well, Morgan Stanley's second point is investors might have already overdone it with that.
Overcompensated, you mean?
Yeah, they're suggesting that a big chunk of that term premium is already built into the current bond prices.
So the market's kind of priced in a worst-case inflation scenario that might not even happen.
That's their view. And if they're right about that, it means U.S. bond yields, they're more likely to fall than rise.
Which would really undermine the dollar's recent strength.
Exactly.
Okay, so that brings us to these specific currency pairs they're recommending for trading. They mentioned GDP USD, Euro USD, and USD JPY. Let's start with the pound. I mean, sterling's been all over the place lately.
It has, and Morgan Stanley sees it as really undervalued right now.
Really?
Yeah. And they're predicting a possible short squeeze that could send GBP USD way up.
Okay, now short squeeze, for those of us who don't live and breathe the markets, break that down for us. What exactly is a short squeeze?
All right, so imagine a bunch of investors, right? And they're betting the pound's going to keep falling.
Betting against it, essentially.
Yeah, they borrow pounds, sell them right away, hoping to buy them back later at a lower price, pocket the difference.
Profit from the pound's decline.
Right. But then, let's say the pound unexpectedly starts going up.
Uh-oh.
Suddenly, those investors are facing losses. They have to buy back those pounds to cover their positions, and that pushes the price up even more.
So it's like a chain reaction of buying fueled by panic, basically.
Yeah, you could say that. And Morgan Stanley is predicting the dollar is going to decline, so they're seeing a scenario where those who shorted the pound, they could get, well, squeezed.
And that could send GBP USD all the way up to...
They're saying potentially 1.27.
Wow, that's a big jump. All right, let's talk about the euro. What's their outlook on that?
They're expecting USD to rise too, although maybe not as dramatically as the pound.
Okay.
Their forecast is based on the interest rate difference between the U.S. and the Eurozone.
Right.
So if U.S. yields do fall, like they're predicting, while the Eurozone rates stay kind of stable, that could make the euro look more appealing to investors.
Yeah, because investors, they always want the best return. So if that interest rate gap shifts, it could pull money from the U.S. over to the Eurozone, pushing the euro higher.
Precisely. They see USD going up to at least 1.07, maybe even 1.08.
Okay. And what about the yen? How does that fit in?
For USD JPY, they're predicting it'll drop down to 145. You see, the yen, it tends to have the strong connection to US yields, historically.
So when U.S. yields fall, the yen usually gets stronger.
Exactly. So if Morgan Stanley is right about those yields, we could see the dollar weaken against the yen too.
Interesting. So this whole analysis, it really hinges on this prediction of declining U.S. yields. It seems like a pretty bold call, especially with a lot of other analysts still feeling bullish on the dollar.
It is definitely a contrarian view. And look, if they're wrong, well, that could mean trouble for anyone who follows their advice.
Right.
But if they're right, it could be a really profitable trade.
And it could signal a much bigger shift happening in the whole global currency landscape.
Yeah, could be.
Okay, now I want to go back to something you mentioned earlier, this idea that the pound is really undervalued. What are they basing that on?
Well, a few things, actually. Firstly, the UK economy, it's been doing better than a lot of people expected after Brexit.
Okay.
And that recent trade deal with the EU, that helped reduce some of the uncertainty that was hanging over sterling.
Right, right.
Plus, they think the Bank of England might raise interest rates sooner than the market expects, which would also give the pound a boost.
So it's like a mix of positive economic factors and maybe some policy changes that could work in the pound's favor.
Exactly. And add to that the short positioning we talked about earlier, the possibility of a squeeze,
Yeah.
it all becomes a bit more, well, explosive.
Yeah, like a powder keg just waiting for a spark. All right, now I also want to bring up something we briefly touched on earlier, this news about Trump maybe considering a universal tariff on U.S. imports. How could that shake things up?
Yeah, that's a real wild card. Protectionist policies like tariffs, they tend to create a lot of uncertainty and volatility in the markets,
Yeah.
and they can really mess with currency valuations in unpredictable ways.
So Morgan Stanley's analysis, it focuses on those long-term trends in yields and inflation. But a sudden policy change like that could really throw things off.
It definitely could. Investors might get spooked and run for the safety of the dollar, at least in the short term.
Makes sense.
It's something we got to keep an eye on.
Definitely. Okay, so we've laid out Morgan Stanley's case, their reasoning behind this dollar decline prediction, and their specific trading recommendations. Now let's shift gears a bit and think about what this could mean for our listener.
That's the million-dollar question, right?
Yeah.
How can you actually use this information? How can you, position yourself to maybe benefit from this shift or at least avoid getting caught on the wrong side of it?
Because even if you're not out there trading currencies every day, these trends, they can still have a real impact on your life, right?
Absolutely. Think about it. If you're planning a trip abroad and the dollar weakens, boom, your travel costs go up.
Yeah, it makes those souvenirs a little pricier.
Or say you're an investor with international holdings, a shift in those exchange rates, that can directly hit your returns.
And beyond travel and investments, a weaker dollar can affect the price of all those imported goods we buy, right?
Oh, yeah.
Could fuel inflation, make everyday things more expensive.
Definitely. So it's important to stay informed about these things. Even if you don't trade currencies yourself, understanding these global forces, it helped you make smarter financial decisions.
Makes a lot of sense.
Yeah.
Okay, now let's play devil's advocate for a minute. What are some arguments against Morgan Stanley's view? Are there any analysts pushing back on their predictions?
There are, yeah. Some analysts think Morgan Stanley's underestimating how strong the U.S. economy really is.
Okay.
They're pointing to things like strong corporate earnings, the job market, consumer spending, all that, as proof that the U.S. economy is still in good shape.
So even if inflation cools down, they think the underlying strength of the U.S. economy will keep the dollar strong.
That's their argument. They also think Morgan Stanley's overplaying how much U.S. yields might fall. They think the Fed's probably going to raise rates a few more times this year, which would push yields up, not down.
So there's definitely a debate going on here. Some experts see a turning point for the dollar, others think it's going to stay strong.
And that's exactly why it's so important to do your own research. Don't just blindly follow any one analyst.
Right.
Weigh the evidence, look at both sides, and then make a decision that makes sense for your own goals and your risk tolerance.
Great point. All right, let's get specific here. Let's say you're planning a trip to Europe later this year. How would you adjust your plans based on what Morgan Stanley's saying?
Well, if the dollar does weaken against the euro like they're predicting, your trip's going to be more expensive, right?
Right.
So maybe book those flights and hotels sooner rather than later, lock in the current prices.
That's a good tip.
And hey, look into those travel hacking strategies, earn points and miles, offset some of those costs.
Those are always helpful.
Yeah, you could even tweak your itinerary a bit, maybe visit places that are known for being budget friendly or travel during the shoulder season when prices are usually a bit lower.
All good ideas. Now, what about investors? How can they position themselves to potentially benefit from a dollar decline?
One way is to diversify your portfolio.
Mhm.
Invest in assets that are, denominated in other currencies.
Oh.
Like you could look into European stocks or bonds.
So if the euro goes up against the dollar, your investments would actually benefit from that.
Exactly. You could also explore currency ETFs or mutual funds.
Hmm.
Those give you exposure to a whole bunch of currencies at once.
Okay, good options if you want to diversify your currency exposure without having to, actively manage every little trade.
Right. And don't forget, investing in foreign markets always comes with its own set of risks.
Right, right. Okay, we've talked about travel, investing. But what about for the average person who's not planning a big trip or juggling a bunch of foreign investments? How could this potential currency shift affect their daily life?
Well, like we said before, a weaker dollar can mean higher prices for all those imported goods we buy.
Right.
Everything from electronics and clothes to, well, groceries and gas.
So even if you don't see it directly in your currency exchanges, you could feel it in your wallet at the grocery store.
Exactly. And don't forget, currency fluctuations can have bigger economic impacts too.
Right, right.
A weaker dollar could help U.S. exports become more competitive, which could actually boost economic growth.
Okay.
But it could also lead to higher inflation, which eats away at our purchasing power and could even lead to higher interest rates.
So it's complex. There's a ripple effect that can be felt all over the economy.
Yeah, it's a lot to consider.
Okay, we've covered a lot here. We've walked through Morgan Stanley's analysis, looked at some potential counterarguments, and talked about what it all means for travelers, investors, and just everyday folks. But before we move on, I want to circle back to something you mentioned earlier, the risks of investing in foreign markets. Could you talk more about that? What are some key things our listeners should know?
Sure, one of the biggest risks is, well, currency risk.
Okay.
Even if the investment itself does well, if the foreign currency weakens against the dollar, your returns could shrink or even disappear.
So you could pick a winning stock but still lose money just because of how the currencies move.
Exactly. There's also political risk to think about. Investing in other countries, it means dealing with different legal systems, regulations, and political climates.
Right. A change in government or a new policy could really impact your investment.
That's right. And then there's the question of liquidity. Some foreign markets aren't as liquid as the U.S. markets.
So it might be harder to sell your investments quickly if you need to.
Exactly. You might get stuck with an investment you want to get rid of, or you might have to sell it for less than you'd like.
Right, right.
Those are just a few of the key risks to keep in mind. Do your research, understand the specific markets you're interested in, and hey, talk to a financial advisor if you need to.
Solid advice. All right, let's shift gears a bit and think about the bigger picture here. Morgan Stanley's essentially predicting that the dollar's dominance, it's going to decline. What could that mean for the global financial system as a whole?
That's a big question. If the dollar's strength does fade, we could see a more multipolar world, where other currencies like the euro, the yen, maybe even the Chinese yuan, they start playing a much bigger role.
A world less centered on the dollar. What would that actually look like?
Well, for one, we could see more international trade happening in currencies other than the dollar. Central banks might start holding more euros, yen, or yuan in their reserves.
The U.S. wouldn't have as much sway over the global economy through its monetary policy.
Exactly. We might also see more competition and innovation in the financial system, with countries and institutions trying to come up with alternatives to the dollar-based system.
So a potential power shift, new players coming onto the global stage. It's really fascinating to think about.
It is, and it raises some big questions, like, would a more multipolar system be more stable, more balanced, or would it create a whole new set of challenges and uncertainties?
Right, because this dollar dominance, it's been a key feature of the global financial system for decades. Moving away from that, it could have massive consequences.
It definitely could. It's something we're going to have to watch closely in the coming months and years.
All right, let's bring it back to a more personal level.
Yeah.
What if Morgan Stanley is right? What does this mean for your investments, your financial plans, even your everyday life?
That's what it all boils down to, right? It's not just about abstract economic theories or geopolitics. It's about how these forces can actually affect you, your family, your community.
So what are some concrete things our listeners can do to prepare for this potential shift?
Well, first and foremost, stay informed, keep up with the latest economic news and analysis.
Right, and not just from the usual sources.
Exactly. Get a variety of perspectives.
Don't put all your eggs in one informational basket.
Exactly. And be ready to adapt your financial plans as needed. Let's say you're planning a big purchase that involves foreign currency. Factor in those potential currency swings.
Don't assume the exchange rates will stay the same.
Right. And if you're an investor, think about diversifying your portfolio across different currencies and asset classes.
Don't put all your eggs in one basket, period.
Exactly. And most importantly, don't panic. Remember, even the top experts can't predict the future with 100% certainty.
Right. There's always some uncertainty in the markets.
So take those predictions with a grain of salt, stay flexible, and be ready to adjust your course if you need to.
Good advice. Okay, let's take a moment to reflect on what we've learned so far in this deep dive.
We've gone through Morgan Stanley's prediction of a dollar decline, looked at the reasons behind it, and talked about what it might mean for the global financial system and for individual investors and consumers.
And we've highlighted the importance of staying informed, diversifying your investments, and being proactive about your finances.
Now, in the next part of our deep dive, we're going to dig into some historical examples of currency shifts, see how those situations played out.
Right, get some perspective from the past.
Exactly. We'll also discuss some strategies for managing currency risk and offer some practical tips for navigating a world where the US dollar might not be the top dog anymore.
Sounds good. So stay tuned for more insights and analysis as we continue our deep dive into the future of the US dollar.
History can be a pretty good guide sometimes. Like, there have been times when the dollar's dominance has been challenged before.
That's a really good point. Seeing how those situations played out could give us some clues about what might happen this time. So what are some examples of currency shifts in the past that we can learn from?
One example that comes to mind is the decline of the British pound back in the early 20th century.
Ah, the pound.
For centuries, the pound sterling was the world's leading currency. But after World War I, things started to change.
What happened? Was it just economic factors, or were there political things going on too?
It was a bit of both, actually. The war had really weakened the British economy, and at the same time, the United States was emerging as a major economic and military power.
So the U.S. kind of took over as the global leader, and the dollar replaced the pound as the world's top currency.
Yeah, that's a simplified version of events, but basically that's what happened. Another interesting case is the creation of the euro in 1999.
The euro, yeah. That was a huge deal in the global financial system. Did that pose a serious challenge to the dollar back then?
It definitely had the potential to. I mean, the Eurozone is a massive economic bloc, and the euro quickly became a major player in international trade and investment.
But in the end, the dollar held on to its position as the world's main reserve currency.
It did. The Eurozone had its own set of problems to deal with, especially during that sovereign debt crisis back in the early 2010s.
Right, those economic struggles within the Eurozone definitely held it back from really challenging the dollar's dominance.
They did, yeah. But it's worth noting that the euro's share of global reserves has been steadily increasing over time.
So, even if it hasn't overtaken the dollar, the euro has become a more and more important player in the global financial system.
Absolutely. And it shows that these currency shifts can happen gradually, over years or even decades.
Okay, so history tells us that these kinds of currency shifts aren't unheard of. They've happened before, and they could certainly happen again.
Exactly. And that's why it's crucial to be prepared for a world where the dollar might not be the only game in town.
Now, you've mentioned this idea of managing currency risk a few times. Could you break that down a bit? What are some specific things that people and businesses can do to protect themselves from currency risk?
One common strategy is hedging. It's basically using financial instruments like forward contracts or options to lock in exchange rates for future transactions.
So if you know you're going to need to exchange currencies at some point down the road, you can basically protect yourself from those rates moving against you.
That's the idea. Hedging can be a bit complicated, but it can be a really effective way to reduce uncertainty and manage risk.
All right. What are some other strategies?
Another one is diversification. Like we talked about earlier, investing in assets that are denominated in different currencies can help spread the risk.
Right. So if one currency goes down, you're not completely exposed.
Exactly. You can also diversify by geography, industry, and asset class.
So don't put all your eggs in one basket. whether it's geographically, the industries you invest in, or the types of assets you hold.
Exactly. It's all about spreading your risk and building a portfolio that can handle different economic conditions.
Okay, those are some great strategies for investors. But what about businesses that operate internationally? What can they do to manage currency risk?
Well, one option is to invoice in their own currency. That basically shifts the currency risk to their customers or suppliers.
So if a U.S. company invoices a European customer in dollars, the European customer is the one who takes the hit if the euro weakens against the dollar.
Right. Businesses can also use what are called natural hedging strategies, things like sourcing goods or services from countries where their currency is strong.
So if the dollar is strong against the euro, a U.S. company might choose to buy products from Europe because they get more bang for their buck.
Exactly. They can also set up operations in foreign countries, which can help balance out those currency fluctuations.
Right? If you have income and expenses in multiple currencies, it can kind of even things out.
Yeah, it can. Managing currency risk is a continuous process, though. It takes careful planning and monitoring.
For sure. Now, let's imagine for a second that Morgan Stanley's prediction actually comes true and the dollar does go down in value. What are some of the biggest potential opportunities that might come out of that?
Well, one big winner could be U.S. exporters.
Okay, how so?
A weaker dollar would make U.S. goods and services more competitive in the global market.
So American businesses would have an easier time selling their products overseas.
Exactly. It could also make the U.S. a more attractive place for foreign investment.
Right, because a weaker dollar would make U.S. assets cheaper for foreign buyers.
That's right. And it could give a boost to tourism in the United States, too.
Because for people coming from countries with stronger currencies, a trip to the U.S. would be more affordable.
Exactly. So even though a decline in the dollar might create some challenges, it could also open up some interesting opportunities.
Okay, so potential benefits for U.S. exports, foreign investment, and tourism. Now, let's look at the other side of the coin. What are some of the biggest potential risks or downsides of a weaker dollar?
Well, one risk is inflation. We talked about that earlier. A weaker dollar can make imported goods more expensive, which can drive up prices for consumers.
Right, and if those price increases become widespread and don't go away, it could really hurt people's purchasing power and maybe even trigger a recession.
It's definitely a possibility. Another risk is that a weaker dollar could shake confidence in the U.S. economy and make foreign investors nervous.
So even though a weaker dollar might initially make U.S. assets look cheaper, if it's seen as a sign that the U.S. economy is struggling, it could end up scaring investors away
Exactly. And it could potentially lead to higher interest rates, too.
because the Federal Reserve might have to raise rates to try to control inflation and prop up the dollar.
That's right. So while a weaker dollar might have some positive effects, it's important to be aware of the potential downsides as well.
Okay, so we've talked about the potential benefits and risks of a weaker dollar. Now let's zoom out a bit and think about the bigger picture. What does Morgan Stanley's analysis tell us about the state of the global economy right now?
Well, it suggests that we might be at a turning point. You know, that whole post-World War II era where the U.S. has been the dominant economic and financial power, that might be coming to an end.
A potential power shift, with other countries and currencies gaining more influence.
That's one way to look at it. It also suggests that the global economy is getting more interconnected and complex.
Right, and maybe those old economic models and assumptions we've been using, they need to be re-examined.
Exactly. The world is changing fast, and it's more important than ever to stay informed and be adaptable.
Now, we've been focusing on the dollar's potential decline, but what about those other currencies? Are there any that you see as potential rivals to the dollar's dominance?
Well, like we discussed earlier, the euro is definitely a strong contender. It's the currency of a big economic bloc, and it's already widely used in international trade and investment.
Right, and even though the Eurozone has had its share of difficulties, it's still a major force in the global economy.
It is. Another currency to watch is the Chinese yuan.
The yuan, interesting. China's economy has been growing like crazy over the past few decades, but the yuan isn't fully convertible yet, right?
Right. The Chinese government still keeps pretty tight control over the yuan's exchange rate.
So what would have to happen for the yuan to become a true global reserve currency?
China would need to open up its financial system and let the yuan float freely on the foreign exchange market.
And would they be willing to do that? Wouldn't they lose some control over their economy?
It's a trade-off for sure. They'd gain global influence and prestige, but they'd also have to give up some control over their monetary policy.
It would be a major shift, both for China and for the global financial system.
It definitely would. But a lot of analysts think it's just a matter of time.
Okay, so the euro and the yuan are the main contenders.
hmm
Are there any other currencies that we should be keeping an eye on?
Some analysts think the Japanese yen could be a bit of a dark horse.
The yen. But hasn't Japan's economy been struggling for years?
It has. But the yen is seen as a safe haven currency. That means investors tend to pile into it when things are uncertain globally.
So if there's another big financial crisis, for example, the yen could benefit from a flight to safety.
That's the thinking. Of course, it's impossible to predict the future with 100% certainty.
Right, we can only look at the trends we're seeing now and make educated guesses about what might happen next.
Exactly. And that's why it's important to be ready for a range of possibilities.
Okay, let's wrap up this part of our deep dive by focusing on some key takeaways for our listeners.
We've looked at some historical examples of currency shifts, explored ways to manage currency risk, and discussed the potential upsides and downsides of a weaker dollar.
And we've talked about the rise of potential challengers to the dollar, like the euro and the yuan. We've also stressed how important it is to stay informed and be able to adapt in a global economy that's constantly evolving.
Now, in the final part of our deep dive, we're going to switch our focus from the big picture to the personal level. What does all this mean for you?
Right, let's get down to brass tacks.
Exactly. We'll discuss some practical steps you can take to protect your finances and set yourself up for success in a world where the US dollar might not be the king of currencies anymore. So we've looked at the global picture, but now how do we bring it down to your everyday life? What can you actually do to prepare if the dollar loses some of its power?
Yeah, give us the practical stuff.
It's about being smart and flexible with your finances. Kind of like how we talked about diversifying investments, right?
Don't put all your eggs in one basket.
Exactly. So think about your spending habits. Do you buy a lot of imported stuff? Could you switch to things made locally? That could soften the blow if a weaker dollar makes those imports pricier.
Good point. Plus, it supports local businesses, which is always a good thing.
Absolutely. And what about your savings? Are you holding a ton of cash in US dollars? Might be worth looking into ways to spread that out a bit, maybe hold some in other currencies or assets that do well when the dollar dips.
That's an interesting thought. Diversifying savings.
It's all about managing risk. If the dollar takes a big dive, you don't want all your money tied up in it.
Okay, that makes sense. But let's say someone can't make huge changes to their spending or savings right now. Are there smaller things they can do to start preparing?
Oh yeah, for sure. Small steps can still make a difference over time. Like if you're thinking about a trip abroad, do some research on destinations where your dollar will stretch further.
So maybe skip Europe this year and check out Southeast Asia or South America instead.
Exactly. Or if you're planning a big purchase, see if you can hold off for a bit. Wait and see if the dollar weakens more before you buy. You might save a chunk of change.
Yeah, timing can be everything, especially for those big purchases.
Totally. And for business owners out there, think about your pricing strategies. Could you adjust your prices to account for these potential currency swings?
That's key for businesses that rely on imported stuff. Don't want to get blindsided by a sudden price hike.
Right. And think about your suppliers, too. Are you relying on suppliers in countries where the currency is likely to get stronger against the dollar? Might be worth checking out some other options.
So, diversifying your sourcing and supply chains, just like you would diversify your investments and savings.
Exactly. Be proactive, think ahead, and be ready for different scenarios.
Now, we've been talking a lot about the dollar potentially going down. But what if it doesn't? What if it stays strong or even gets stronger? Should people still be thinking about all these preparations?
Absolutely. Even if the dollar stays strong, these are all good things to think about. Building resilience into your financial life is never a bad idea, no matter what the currency markets do.
Right. It's about being financially smart and thinking ahead, not just reacting to what's happening right now.
Exactly. And don't forget, even if the dollar doesn't weaken, other currencies could strengthen, which would have a similar impact on your purchasing power and investments.
So it's not just about the dollar itself. It's about paying attention to those broader trends in the currency markets.
And understanding how those trends can affect your bottom line.
Okay, we've really dug into this topic today. We've analyzed Morgan Stanley's predictions, looked at historical examples, and talked about practical ways to prepare for a potential shift in the currency landscape.
And we've stressed the importance of diversification, flexibility, and taking a proactive approach to managing your finances.
So to wrap things up, what's the one key takeaway you want our listeners to remember?
I think it's this. The future's always a bit of a mystery, but we can do things to get ready for whatever comes our way. Don't freak out, stay informed, and be proactive about your finances.
Fantastic advice. This has been a really interesting and eye-opening discussion. Thank you for joining us for this deep dive into the future of the U.S. dollar.
Always happy to be here. You know I love talking about this stuff.
And to our listeners, we hope you found this valuable too. Remember, the information we've shared is just a starting point. Do your own research, think about your own situation, and make decisions that work for you and your financial goals.
And as always, stay curious, stay engaged, and stay ahead of the game.
Until next time, happy investing.